Good morning, everybody. My name is Steve Benham, and thank you for joining this webinar, which is the second in the series for the AICPA. Just a couple of admin items. We will leave some time for Q&A towards the end, 5 or 10 minutes. If you have any questions, please use the chat, and Grace, who is coordinating this, will ask the questions for you at a suitable moment, probably towards the end. Okay, so FP&A transformation when disruption is the new normal. I've deliberately not used the words which are overused at the moment, unprecedented, unusual, etc. Because my belief is that disruption is pretty frequent these days, major disruption which undermines some of the premises of your business. And typically finance departments are not equipped to do what is needed during disruption, which is to reforecast very quickly and run a number of scenarios. So this webinar is going to be about how we achieve rapid forecasting and scenarios. There we go. So just a little bit about myself. I'm FCA, have been practicing as a chartered accountant for about the first 20 years of my career. And then in the middle of it, I moved into enterprise performance management. And I've had a number of different roles, ranging from a delivery consultant through to sales roles and through to one role where I was VP Rest of the World Sales, which involved running about 10 distributors around the world. And in a way, I've never really left this enterprise performance management sector. What are we going to handle today? So the first webinar in May, I believe, was about how we improve FP&A processes and make them more efficient, and how we can generate quite substantial return on investment from that. So I'm going to do a very quick recap on that, but I'm really going to focus most of the webinar on forecasting, and I call that how to become a fortune teller. And at the end, we'll just talk about a case study of a very good client of ours who are working hard to get to this place. So just a quick recap. We describe FP&A processes as either traditional, transitional, or transformational. Traditional, typically, when you look at these processes, they're wasting an enormous amount of time and resource, and obviously time is money. Transitional is where we've automated most of our processes and they are pretty efficient. But in reality, what business executives want from finance is they want you to be adding value to their decision making, and we call that transformational. How do you tell where you're at in that sort of maturity? Well, one way is to look at what your finance teams are actually doing. So if you look at the traditional finance department, most of the people in finance are doing data manipulation. It's a high amount of effort. They typically only manage to produce a year to go type forecast of actual year to date plus the remaining budget. And if they're ever asked to do forecasts, then they have to make basically what are unreliable assumptions in order to produce any forecast at all. Transitional, the processes have all been automated to a reasonable degree. They're able to do a quarterly reforecast, and they're able to, but really the forecasting is often still only year to go. So if you have current year to date as month 9, then they'll add on 3 months to take you to the year end. The forecasts will be in the reporting pack, but actually reforecasting to the planning horizon of the company is pretty rare. And then if you're transformational, then this is where my role as fortune teller comes in. And the key issue is almost one of attitude. It's like whenever you're reporting, you're focusing on the outcome of executive decisions, or for telling people, what that decision is likely to produce if they actually execute it. We might have a bit of predictive analysis going on, maybe with even some artificial intelligence on your sales forecasts. And the underlying plans will be underlying operational plans like sales forecasting and operational, maybe production planning, will be linked to the main forecasting functionality. And in the best companies, they have a good understanding of their business processes. I don't just mean FP&A processes, I mean actual business processes, and they've identified what the key drivers of those processes are. And by drivers, I mean the things that cause cost. So we're not going to linger too long on the first two because we covered that in the previous webinar, and I think we can get a download after the webinar, and you'll be able to follow the original webinar if you want to on that link. And just a reminder of the sort of return on investment that is possible just by moving from traditional to the more automated roles. It's, as you can see, most of the return on investment on this page, it's in a Forrester total economic impact study, is based on improving efficiency. Though there's not a lot there on actual adding value as a finance department. So what are the main processes we're going to talk about? Hopefully you'll recognize these. So on the left hand side, we've got reporting historic performance, in other words, reporting monthly actuals. Hopefully we are doing some forecasts of future performance, and if you are able to do forecasts well, as in other words quickly and to a good quality and frequently, then that will then enable the ability to run scenarios with other assumptions, and it'll make your planning process much easier as well, because really it should just be picking up the latest forecast and maybe changing some of the assumptions. So fortune telling in business. It's not just a crystal ball. I know the name may suggest that we go and see a little lady on the amusement arcade, but we need a little bit more sophistication in business. So I'm going to deal with the processes of forecasting. I'm going to deal with some functionality that you need available. We'll have a look at the business processes, just an example of that, and we'll look at some technology. And finally, and this is probably the most difficult for most departments, we'll look at some of the people and roles. So what does a typical 12-month rolling forecast look like, and what's possible? So you can see on the left-hand side, we've got finance, we've got the horizontal swim lanes are the roles, and we have finance in a fortune teller role. And we have a few, just to explain some of the symbols. I have something called an integration point, which is where maybe some data comes in or the process starts. we've got some key milestones in the process, and we've got some analysis between some automated processes and where we're actually doing some analysis. So let's say we start our process, and the first things we do is update the forecast version with maybe the latest actual performance, and then we want to load the latest operational forecasts, and normally that's the key one is the sales forecast. Certainly in my experience, sales forecasting is by a long way the most difficult to get anywhere close to realistic. So then we would, in finance, we'd review that forecast, and we might override it as well and say, well, that's just not realistic, or they've made the same mistake again, or something like that. But then, assuming you've got the right technology and functionality, you would then probably run your forecast by the sales director. And there we have another role, which is sort of sales and operational managers. So, and you may well be using some connected operational plans as well, and you would get them to give their input on your forecast. At that point, probably we'd have a review with the CFO, make some amendments for whatever reason, and then that would be sent out to the executive team, maybe even the board of directors. So what you would notice from this is I've deliberately done it over 2 or 3 days. This may sound very short, but many of the companies we deal with, they do manage to do it in about a day. So 1 day is possible, 2 or 3 is more normal. Excuse me, I'm just going to have a drink of water. The other thing really is the dark blue is the time left for analysis. So because things are automated and the process is sort of, if you like, well thought out and tried and tested, the amount of time spent on data manipulation has been reduced down to 0, and the most of the time is spent either in finance or in the operational departments on analysis, and they have the functionality, which we'll come to in a minute, to make amendments in real time online. The other thing is very important is this engagement and collaboration with the sales and operational managers, because without that, the forecast really is being done in a silo and won't have sort of a consensus across the executive team. Okay, we've been through this. Okay, so let's talk about functionality. The first thing you need is some financial modeling capability, and that may seem surprising that many finance departments really don't have what I'd call a good financial modeling capability. In the traditional departments, it's nearly next to non-existent. They would argue they have it because they have it in spreadsheets, but actually I came across a company recently that had 150 disconnected spreadsheets, which had to be aggregated by finance in order to produce a plan, and not surprisingly, they never did a forecast. In Transformational, everything's integrated, P&L, balance sheet, and cash flow. It's integrated to underlying sales and operational plans, and they're able to produce rolling forecasts to the planning horizon, which may be 12, or it might even be 24 or 36 months I've come across. Profit contribution, I've used the word contribution very deliberately. that's a layer or two, or a level or two down from gross margin, down the P&L account. In the traditional, we'll find that any analysis at all is restricted by G&L, general ledger accounts. I've come across some, in particular, I think it was in an airline, we had about 1,000 revenue accounts, but because they wanted to analyze revenue across many, many different dimensions, but actually it was never correct because the maintenance of those accounts was almost impossible. And that in turn limits the amount of gross margin analysis that can be carried out. And nothing wrong with standard costs in themselves, but they are very often limited to just using standard costing when maybe marginal costing or some variable costing would be more appropriate. In the transformational, what we see is much more highly dimensioned. They're able to look at profitability by customer and product and distribution channel, and it may be other dimensions as well. They know what the drivers of cost and of costs are, what the causes of costs are. They're able to forecast those driver volumes, and they know what the average sales prices or unit costs per unit of driver are. And because of that, they're able to produce on a regular basis things like cost to serve, or like, for instance, life cycle product contribution on a much more frequent basis. In order to do, I've alluded to this already, in order to do profit contribution analysis, really you need to have a good understanding of the business processes. And I'll dig down into a bit more detail in the business process in just a minute. In traditional, the end-to-end is just not understood. In the more transformational business, they've got a very clear understanding of what the business processes are, and they're able, and their drivers, again, the causes of those costs in those processes. And the really good ones are able to take the cost on a standard basis. They cost the process failures, and I'll talk about a little bit what those process failures might be in the next set of slides. A prerequisite really for fortune telling is that your processes, your forecasting process, is automated, and that really requires good data integration. Again, in traditional, as I mentioned earlier, we have these often hundreds of spreadsheets involved in a forecast process, whereas in the transformational, they're able to pull the latest sales forecast, for instance, on demand. As you've seen in the process slides earlier, remote data entry is fundamental to collaboration. It's important that the operational departments and finance have the ability to override maybe a forecast that's been produced through extrapolation or some calculation, as to deal with the obvious. And in the transformational, we have a central model on cloud servers, which allows remote data updates, maybe of factors or unit rates and expense forecasts. And finally, the most important one maybe is the reporting tools. Excel in itself is a good tool, except that it's siloed. It's actually built as a personal tool, and because of that, it's very laborious to use Excel for reporting. It's not mobile enabled, and because of the time it takes to produce, to actually aggregate and transform all the spreadsheets, and the pressures that finance are under to produce a forecast, they often make some pretty unreliable assumptions in order just to get the forecast out and on the executive table. In Transformational, we can run scenarios in real time, and we focus on predicting the outcomes of executive decisions. Some people may be sitting there thinking, well, that's all very well and good, but how on earth do you achieve that? So I've just done a quick summary of things that I've seen and things I've done myself in the past. I mentioned earlier that the sales is by a long way the most difficult, and this is what companies are doing now. They're taking their latest sales forecasts from their customer relationship management system. In most businesses with a fairly large sales force, the account execs are required on a regular basis, sometimes daily even, but certainly weekly or monthly, they're required to commit to sales that they will close in the next month or two. So that's the sort of baseline for your sales forecast. Then to that, from the CRM, it should be possible to identify opportunities and maybe qualify them with some probabilities. And on top of that, there could be some what we call white space, which hasn't appeared yet in the CRM, but is sort of historically, new opportunities occur beyond the sales cycle. And then with those things, you should be able to take volume and some measure of sales price and byproduct, customer and channel. Just a thought, and I've seen this have a very, very good effect on profitability, is to, rather than rewarding sales teams on revenue, but to reward them of the accuracy of profit contribution. Obviously, some of the costs are out of their control, but things like actually the cost of say distributing. I saw actually an example in an oil products company in Belgium where they were rewarding sales on revenue and making some big losses because the sales team had no interest at all in the method of delivery, and they were choosing road tankers to distribute the product, which is a very, very expensive form of distribution, but quick, over, say, a barge, which is taking a high volume of product, but at a relatively low cost. So they changed to rewarding the sales on the accuracy of their profit contribution forecast. And from memory, it increased their profitability by about 100% over a year or two. Cost of sales and gross margin, I think based on the sales forecast, you should be able to extrapolate or calculate the costs of gross margin. Certainly, similarly, distribution costs should be possible to extrapolate or calculate. Then we move into sort of the marketing costs, where really they need to be by campaign, and often this is where we need this manual data entry type functionality, because the campaigns might be speeded up or slowed down depending on what's going on in the marketplace, and we need high collaboration with the marketing department. Similarly, with support services, should be possible to extrapolate, but it still needs some override functionality from the support service managers. And indeed, we might have something that I call business sustaining type costs with audit, tax, interest, legal type costs, which are possibly extrapolated from budget or just copied from budget or plan. But there needs to be this ability to override anything that's known about already. Okay, I'll probably start talking a little bit about business process, and this is I don't think it's particularly original. I've acquired these sort of techniques from a number of different sources, so I'm not going to claim intellectual property on any of this, but this is the way I try and help clients to understand, in a way, it's understanding their business. So these are just the generic processes that I start from. So we've got an investment and disinvestment type process. We've got a process which is creating customer demand. This is the marketing processes. We've then got a process. I'm going to jump actually to fulfilling demand. So I make a difference between the marketing, which is creating the demand and getting customers to come to you, and fulfilling that demand, which is, if you like, taking orders and delivery of, if it's services, it might well be delivery. So this is getting the product or the service to the customer. In the middle here, I've assumed a manufacturing company, actually, or a distribution company, where we're replenishing stocks. And then the fourth one here is to make or buy saleable products. Now, these are very generic, clearly not appropriate to almost any business probably. So what's important now is to work on these with the executive team and get a consensus on the following things. Sorry, I haven't mentioned that there are some plan management control processes and some support processes which are often wrapped around these things. So we need to review this chain and convert it to terminology which means something in your business. So I'm going to just stay with the manufacturing business just for the purposes of this presentation. And the other important thing is, when we're looking at this, we need this process description needs to succinctly explain the value that this process brings to the business. So if I just swing these things in here, if we just take invest and disinvest, I've added from products and markets at an internal rate of return of greater than 10%. Now, of course, those percentages and the measure may be wrong, but the important thing is to have something in here where you can prove that this process is going to add a value. Creating profitable demand is pretty tricky, to be honest. So marketing is the direct connection between a profitable sale and a number of different marketing campaigns is not always easy to identify, but it's worth having that word in there, profitable, just to remind everybody that marketing is not an end in itself, and sometimes it sort of runs out of control and spends an enormous amount of money. I have an example from years ago where an American company tried to enter our market. They spent an absolute fortune on TV advertising and stuff like that. Actually, we took our product, which is a competitive product, into Halfords, put it in the end of our bins, and their marketing helped sell our product, which is fantastic. And then in the replenishing stocks, actually, we don't just want any old stocks. We want finished goods, or saleable finished goods, perhaps. And we might add they need to be there just in time to fulfill customer demand. But the whole process also involves paying suppliers. So the process is not just about making or buying stocks, it's about sourcing suppliers, and it's about paying the supplier's invoice. So it's a full end-to-end process. And similarly, on fulfill customer demand, it might well start from an order being placed by a customer, but it doesn't finish until the money is in the bank. And therefore, those two processes do go horizontally, let's say, across finance. They include a lot of the cost in finance. Let's just talk quickly about make or buy saleable products, because I've got a little bit of a question mark in my mind on that, which I will come back to in a minute. Because if we're replenishing finished goods stocks, then part of that could well be manufacture, or it could be part of that process is manufacture or buying the goods in. And there's a question really as to whether that, especially if you have a manufacturing process, whether that should be broken out as a separate high-level process. So having done that, and this discussion, I hope you would agree that the discussion about the value that each process brings to the business could be quite controversial, but it should be possible to do that with a couple of sessions with the executive team. And having done that, we then need to identify the key outputs from each process, and then we need to go down a level to what I call a level 2 process and identify the causes of cost, the drivers, and the inputs to each one of these processes. So I'm going to move on to that. So again, I've stuck with this sort of manufacturing type example, but it's equally applicable to services or insurance or airlines. So I'm not going to go through every single process. Typically, it should be possible to describe any of the high-level processes in between 5 and 10 process steps. And it should be quite easy to identify what each of these process steps outputs. So if we take the high-level level 1 process, replenishing and pay for finished goods stocks, then you could say that the supplier remittance is the output, because that's the end game is to, the end of the process is to pay the supplier. But the most useful piece of information is actually what triggers that process and what kicks it off, what's at the start of the process. So the start of the whole process could well be purchase orders. It might be purchase order lines or something else. And I've deliberately left this one for the manufacture process out, because the purchase orders, short stock components, goods received notes, purchase invoices, and matched purchase invoices typically vary in a linear way to the number of purchase orders. Not always true, but on the whole they do. Whereas manufacturing could be some other cause of cost which doesn't vary at all in any linear way with purchase orders. So that would be a reason to break out that process. Also, it may be a very large part of the cost. That would be a reason to break that level 2 process out and treat it as a high level process in its own right. Okay, so we've talked a bit. So the process trigger, in other words, the volume that is right at the beginning of the process is likely to be the correct cause of cost for costing purposes. And the level 2 drivers are normally proportionate to that. And why is that interesting? Well, if we say, well, let's say that the cost of purchasing, of the purchasing process and of the warehouse and of accounts payable is, or a proportion of that is 1.2 million, and we have 6,000 purchase orders a year, then the cost per purchase order is 200. Now that's a number that you can work on. You can then set a process owner a target to reduce that cost. Or for instance, if you can just make the mental leap into, say, the fulfill customer demand process, and you said that each sales order cost you £1,000 to process, then you wouldn't want to be taking a sales order which was less than £1,000 of sales value. So there's these volumes and unit rates are important measures to manage your business with. So just moving on to technology, what you can see here is some, in the brown is some source systems, general ledger, customer relationship management system, and maybe some other production systems, or maybe a time management system if you're in a service business. And the technology you really need to aim at is, first of all, that there is an ability for the tools you're using for enterprise performance management, for fortune telling, are able to pull data from these source systems and transform it. So, load and transform. Working through these blue symbols, I'll just go up again on that. You need your forecasting model. You need to be able to do remote manual data entry. This is remote manual data input. You need to be able to produce integrated P&L, balance sheet and cash flow with some KPIs and with some scorecards. And the whole integrated platform needs to be able to give you a multi-dimensional customer, product, channel type view of your profitability, sales and costs. And it must have some slice and dice, drill downs, graphs, commentary, which are pretty common these days. But the key thing is the multi-dimensional. And many planning tools out there which are restricted, severely restricted to general ledger accounts, and that's just not good enough. I've used the word, you need a data mart for your enterprise performance management. Many companies take the approach of implementing some massive data warehouse, which takes them years. I really strongly recommend you don't go down that route, and you focus on getting your enterprise performance management on your own data mart, which is organized in a way to support your forecasting, planning, scenarios and actuals reporting. So that's the manual data entry, and all of that in the dark blue needs to be integrated on a cloud platform. So if you go down the technology, if you feel your technology is not up to it, especially if you're currently relying on tens, if not hundreds of spreadsheets in your planning and forecasting and scenarios process, then you need to look carefully at technology. And I've just made a list here of the key things that you should look for and beware, and a few things to beware of. I've been on both sides of the fence, both on the software selling side and on the client side and on the service delivery side, and so I'll sort of share some of these little, hopefully, nuggets with you. So financial modeling, you need to look out for a really friendly language. Software demonstrators, pre-sales people, are exceptionally clever in demonstrating their software and hiding the fact that there are multiple scripting languages that you need a degree in IT to actually use. And of course, that result means it'll be very expensive to maintain going forwards, to set up and maintain. You need a flexible, be able to achieve a flexible data model where you can change hierarchies. You need at least to be able to have hierarchies for time, organization, product, customer, process, and channel. Many tools, many planning tools are restricted to accounts and cost center reporting. They'll say that they can do other things, but it becomes a bit of a modeling nightmare to layer them on top of the way they treat general ledger accounts. Support and training is often not visible, and it's fundamental to having a 5 or 10 year use of a tool that you invest in. So you should look for some genuine cloud-based library of functions. Look for maybe some worked examples of how those functions work, and that will make it a lot easier for you to do the modeling yourself. If you're a global business, you should certainly look for a 24/7 support desk. And then the training, just check that the training, whether or not the training is on demand, and indeed whether it's included in the license cost, or whether there is a hidden expensive training cost that you'll get hit with after you've invested in the product. Data integration we've already talked about, but most common really is that a lot of people will try and make this very complicated and sell you an ETL tool. For most EPM type things, a push from a CSV file from a source system is probably good enough. What I would say is that many tools will struggle with the volumes that you might get out of your CRM system. You need to be able to probably load a few 100,000 lines in a matter of seconds. It's worth running that test. Remote data entry is not always available on tools. Certainly in the fairly recent past, in the major ERM tools, if the actual getting remote data entry to work requires stitching together a number of different components, and it's really quite difficult. So you definitely need to make sure that's in the integrated product. And finally, reporting. What I'm coming across a lot at the moment is accounts departments, finance departments who are tied to producing a spreadsheet pack. Then they maybe print it to PDF, and then they either circulate paper. I've seen 50-page documents being distributed around the business by snail mail. I've also seen those 50-page PDF documents distributed by email. I've even seen spreadsheets distributed, and there's all sorts of problems with that, including the time it takes you to do that, which is really not necessary, because your integrated tools should be able to produce executive quality reports in real time in the cloud and mobile enabled, so they can do it on their iPad or iPhone from home. Okay, last thing on how to achieve fortune telling, people and roles. So we've talked a little bit at the beginning about Data Manipulator. You'll find this in the traditional roles. You'll find this person is a key person. If they're ever away or sick, it's pandemonium, because we don't know how to deliver the forecast or even the management accounts. This person is highly skilled at correcting errors in spreadsheets, because they have to be. They're often need praise constantly for working as much overtime as they do. They don't produce a balance sheet and cash flow, because that's a different role and maybe a different set of spreadsheets. Really struggle to produce a forecast in less than 4 weeks, which is just not quick enough. And really, the biggest issue is there's no time in the process for anybody to do any real analysis and understand what the cause of your profit is. In the fortune teller role, a guy called Gary Corkins has written a very interesting paper, probably 10 or 15 years ago now, about renaming finance directors to chief profit officer. I actually think it should be future profit officer. So I think we should now call CFOs FPOs from now on, to make the point. They need to be the owner of the they are the owner of a financial forecasting model. The focus is on reporting the effect on outcomes of executive decisions, possibly bringing it to do some prediction, particularly in the sales side, using the data and getting some algorithms going to predict the forecasting. And there's a constant dialogue with the departmental managers around the cause of cost and the effect on the outcome, the cause, the decisions and the effect on the outcomes. And there needs to be a deeper and deeper understanding of the end-to-end processes and their drivers, and then the company will have the tools to run their business. Okay, last section, just going to quickly cover off how this has been achieved in the real world. The company, our current favorite client is SUSE. SUSE is a company that provides software services around open source software. They turn over, they're quite a large company in the scheme of things. They're turning over about $500 million and growing rapidly. They started this vision for fortune telling in November, December last year, and they started with a 3-year plan. That was delivered very quickly in January, end of January, and then this is where some of the connected stuff comes in. They then connect that plan. They provide top-down total contract value and annual contract value as revenue targets into a revenue forecasting use case. That in turn is used in setting country targets and account exec quotas. That then rolls into incentive commission management. So these blue use cases are separate modules, let's call it, but they're all connected when they need to be, so that if, for instance, the 3-year plan changes, then the effect can be rolled down into incentive commission management in real time, if necessary. Then they have a very interesting way of doing their sales forecasting. They're able to do a daily sales forecast, an update on a daily basis. Again, that comes in as comparatives to their targets and quota management. And the chief customer officer in this company is extremely excited to be able to manage his team in this way. I'm not so sure the account execs are that impressed, but anyway, that's the way it is in sales. And this all then, because they're doing regular sales forecasts, they're able very quickly to put together at least the sales line in their annual planning, and that then rolls back into the 3-year plan on an annual basis. There's other things they're doing, but this is the sort of high-level summary, and the most important thing here is how all of these modules are connected together and allow each piece to be viewed the latest position or the latest forecast in real time. And they're just about now to incorporate the monthly financial actuals into this system as well. So they've then got the actual performance reporting rolled into it as well. Just a quick word on how they do their sales forecast. We touched on this earlier. They take their active revenue base. This is their licensed or contracted revenue, and it's actually pulled from a SUSE data warehouse. They add to that the sales opportunities, which come from SFTC, stands for Salesforce.com. So that comes from their CRM system, and then they, the sales or the executive team then add on any unknown or unqualified sales opportunities, or to align the sales forecasting to plan, or indeed to reflect any changes that they think are necessary to the plan. It's highly dimensioned. There's an enormous number of dimensions in there. I'm not going to go through them all, but you can see down the second half the channel, product, customer type, and the important thing is here that they're able to be amended quickly with this sort of single integrated planning platform that they have. Finally, they just a quick view on how they roll their planning and forecasting forwards. So for the first planning cycle, which is in their case 3 years, so their planning horizon is assumed to be 3 years. They will run a forecast, a reforecast every quarter. So in year 1 of the plan, they will get a quarterly reforecast, plus the annual budget, which is part of the 3-year plan. And that gives them a fully integrated long-term plan with forecasts and budgets. If we then move forward to year 2, clearly year 1 of the original long-term plan is done and dusted. They will continue to do their annual budget and their quarterly forecasts. But as part of that, if you like, planning cycle 2 process, they will re-look at their long-term planning and target setting and adjust it to accordingly. And obviously the budget process and long-term plan alignment is part of that. And then year 3 is the same again, but again, just fairly obvious, but the reforecast is based on any changes in the marketplace or in their customers or internally, and they do that to a 12-month rolling horizon. Last thing, just a little bit about Provident. This is a selection of our clients. As you can see from the blue countries, our clients are spread all over Europe, and indeed a little bit beyond. We have a client in Turkey, and the eagle-eyed of you will notice that Itetsa is a Cuban telecoms company. We're able to do that because we're virtual. We don't have any offices as such. Our consultants are based all over Europe, and it really makes little difference in cost or travel time, whether we have to travel from, say, the south of England to Edinburgh to see a client, or we have to travel to, say, France or Spain or Turkey. We just manage that. An interesting thing we worked out the other day, we actually have 11 native or bilingual languages spoken amongst our relatively small team. So I'm nearly done. Thank you for listening, and I hope you found some of that interesting, if not a little bit challenging. Time for me, hopefully, to shut up and answer any questions.
Okay, Steve. I've got a question here. This seems like activity-based costing. Historically, this requires massive data gathering and becomes an industry in its own right. How is this different?
Okay, let's just shove up. Oh, go wrong way, gone the wrong way. Let's just quickly shove up that slide so we know what we're talking about. There, up one. So what we're talking about is this sort of business process perspective. It's certainly true, and I spent some time working with activity-based costing, and we used to produce models with 600 or even 1,000 activities. And then we'd cost them for the first time and found that 80% of them had less than £10 cost in each one. So that's certainly a good question. Doing it this way, you should end up with no more than 50 level 2 activities. So these level 2 items here, you should have 5 to 10 in each process, including the support processes. What I recommend is you try it. You can do this type of analysis, or even this step here of just understanding what your main business processes are and what value they produce, and having that discussion with the executive team is valuable in itself. If you can take it a step further and work out what these level 2 processes are, and what the trigger for each process is, then you have some KPIs. And it isn't difficult to find these volumes. And what I always say is, try it. Obviously, don't spend years trying it. Just do it quickly in maybe a month. See what information you get out. If you're missing data, estimate it. It is amazing how accurate an estimate can be. I think that's all I have to say really on that.
Okay. You referred to Anaplan. Why Anaplan?
Okay. So I haven't made any secret of the fact that we use Anaplan in nearly all our delivery. Let's just move that in there. So the key thing about Anaplan for us, the reason that we're an independent, we're a business partner of Anaplan for sure. So perhaps independent's the wrong word, but we are an independent business. We don't have to use Anaplan. We choose to use Anaplan, and we've got the 3 directors have got a minimum of 20 years experience of delivering planning and forecasting projects using a number of different tools, Oracle tools, SAP tools, and Anaplan is genuinely integrated product. You don't have to stitch together. To do that, what's inside the black box in most tools, you would need to stitch together a number of different components. You need a separate ETL tool, you need a separate reporting tool, you need a separate database tool, and then you might have a modeling tool layered on top. Remote data entry is very difficult in a number of tools. It requires another component to be integrated, and all this integration takes a lot of time and requires a lot of expertise, whereas Anaplan, we find we can model exceptionally quickly. And if I just go down to the case study, here, if I just go to here, we've with the client, I mean, not it's had full client engagement. We've achieved all these things in about a year. And frankly, when we delivered the 3-year plan in Anaplan in about 6 man weeks, and we could only do that because the modeling that Anaplan provides is so flexible and easy to use. And then if we layer on top of that the reporting capability that Anaplan now has fully integrated, then we decided to use Anaplan 3 or 4 years ago, and we're very happy with that decision to recommend it to our clients. Okay, any other questions, Grace?
Yes, just one more. What is the time typically necessary to move companies from each stage, from traditional, transitional and transformation? Is it about mindset change or something else?
We certainly need to do some change management with mindset. That mindset is often in finance. The executive team are often very ready for it. They want value adding from finance. The time there's in front of us is the sort of time scale that, I mean, a lot of this is sales transformation, sales forecasting transformation, and sales, sales related modules. But all of this has been achieved in a very, very quickly.
Okay, thank you, Steve. A couple of people have asked about the webinar recording being available. That will be available after the webinar is complete, and we will circulate that to all attendees and registrations afterwards. We've had a couple of comments about the webinar, so thank you to the people who've made those comments. And I will also be issuing a survey, just a very short survey, but really appreciate if you could take 2 or 3 minutes just to give us your feedback and let us know what you think. That'll feed into future events. So thank you everyone for attending, and thank you, Steve.
Thank you, everybody. Good luck with your fortune telling.